Exela Technologies may have avoided being delisted last week, but their latest earnings data does not mean their woes are over. Hi again, everyone. I hope you're all doing really well. I know I've spoken a fair bit lately on here about Exela Technologies' potential delisting and how the avoiding of that could be the trigger of a potential short squeeze. Well, since the company seems to have avoided the delisting threat via their recent reverse stock split, the company looks set to be dealt a tough hand when trading resumes on Wednesday on account of the weaker than expected earnings data, which they have produced for quarter two. When you factor in the broader market apprehension about the next round of inflation and potential rate rises, news from the Fed, this, at least in my mind, will cast some temporary doubt over a potential short squeeze mounting in the stock. Anyway, the headline of XELA Q2 earnings data was that they missed analyst expectations and posted a quarterly loss of $3.22 per share. The analysts, of which there are only two, on average were expecting the loss to be about $1.30 per share. The underlying issues contributing to this larger than expected loss was the continued slide in revenue from the company. XELA had a 9% quarter-on-quarter drop in revenue and missed the analyst expectations for the quarter by only achieving $266.77 million versus the $290.98 million in revenue expected by analysts for Q2. So then you have to ask yourselves, how did the analysts get it so wrong? Well, it seems to be a case of them falling asleep at the wheel, as none of them had updated their earnings estimates for about 3 months, and based on those estimates and the effects of the 20-to-1 reverse stock split, there is amazingly still a $23.50 12-month price target on the stock, with the two recommendations from the analysts covering the stock being to either hold or a strong buy. Given how far XL has fallen in the past 12 months, the lack of analyst attention is not surprising. Big research firms generally tend to avoid penny stocks and microcaps because it is hard to gauge what is happening with the company. Given Exela Technologies actually has a large commercial footprint, it still does attract the eye of some, though it is not a very closely watching eye, to say the least. One faint, and I mean quite faint, silver lining about Exela Technologies' latest earnings results is it is a continued improvement on the previous 3 quarters, which, while painful in reality, still lends itself to a story that things are slowly improving with the company, with their Q1 loss being $3.40 and their 2021 Q4 loss being $12 per share, respectively. A loss of $3.22 in Q2 is a sign of modest improvement, at least at a surface level, as I'm obviously not considering the effect of revenue flows timings throughout the year, of which I'm not totally across. Looking at the results, there were a number of key victories for XELA. Their overall debt is now $118 million lower than it was the previous quarter, and there appears to be some segments of the business achieving substantial growth. Future cash flows look strong, with a 294% growth in total contract value compared to Q1, which has been partly driven by the increase to small to medium business uptake in products such as digital mailroom and DrySign, which have respectively gained 343% and 1700% in total sales since Q2 2021, although these are relatively new services, so therefore their growth figures might be a bit distorted by this. On the downside, one of the looming issues with Exela Technologies is the threat of dilution through their equity raising facility with B. Riley Capital. And these results do show that it was partly utilized to the tune of $58.2 million raised through the quarter, which is significant considering that currently the market cap is only $95 million for Exela Technologies. In terms of being a going concern, i.e. will the company still be around, Exela Technologies' earnings revealed that there is $72 million in liquidity available at the moment, which is a notable improvement on the figures when you look at what they were back in late 2021. Now, I'm not here just to try and pump up the stock. Like I've said for a while now, my interest is largely tied up in the preference shares, but it is worth highlighting that as a snapshot, this is not a business that is in a great financial position. However, there are signs of slow improvement. Whether this improvement is enough to warrant a, let's face it, an out-of-date 12-month price target of $23.50 per share is probably not the case. However, I do think that a higher share price is warranted from where it currently sits at $1.47. These earnings results sparked an aftermarket sell-off in the stock, where an 11% slip in the stock price came about following the results release. This saw the low volume window close with XELA trading at $1.25. So it will be interesting to see if this is matched in the regular session on Wednesday, or if it was a panic sell that pushed the stock down in this window. Time will tell. In terms of an update on the short squeeze potential, things were headed in the right direction for Exela Technologies with the stock holding out last week above the $1 mark. However, it seems that the number of shorts in the stock have dramatically decreased, with the outstanding percentage of the float short now being reported at only 5.8% on Fintel, way down from the 80% figure where it was at last week. How I think this might have been a partial effect of the delayed timing of this percentage figure and the effects of the reverse stock split. But as XELA stock saw off its NASDAQ delisting threat, it seems those short squeezes were hedging their bets and returning their shares. Average days to cover has also cut right back to 0.26 days, so the remaining shorts may have some pressure to cover. However, I do not think it is significant enough to present any real short squeeze action at the moment. It is worth noting that over 50% of the stock is held in short positions in off-market trades, however, i.e. the dark pool. Anyway, that is about all I'm going to cover for this video. What are your thoughts about the latest XELA earnings? Is it a further step towards the company's demise, or is there enough to suggest that they are making some headway towards turning around their dire financial situation? Let me know your thoughts in the comments below. I know I have been heavily focused on XELA lately, but there has been quite a bit going on, and I have been a bit strapped for time to be as regular as I would like with my YouTubing, hence why I've only focused on one stock lately. Now that this latest chapter on XELA seems to have wound up, at least for now, I will try to give some thoughts on some other companies in future videos, as well as keeping up with what's going on with this stock, because there's always a lot. Until next time, everyone, may the markets trade in your favor. Cheers.